mastering it. Welcome to our journey into understanding the stock market. If you are new to this, it can feel a bit overwhelming. But do not worry, because by the time we are done here, you will feel a lot more confident reading market data. We are going to make everything as clear as possible. Stick with me, and by the end of this, you will be looking at the stock market with a whole new perspective. We are about to dive into an exciting journey where you will learn how to understand the stock market from the ground up. Imagine having the confidence to interpret market charts, decode all those numbers, and know exactly what they mean. Stick with me, because I promise it is not as intimidating as it sounds. We will explore what makes stock prices move, the difference between long-term investing and short-term trading, and practical steps that you can start taking right away. By the time we are finished, you will have the tools to make informed decisions and confidently step into the world of investing. Let us get started and make this an adventure worth your time. The stock market is essentially a place where people can buy and sell ownership in companies. Think of a company as a big pie that is divided into many slices, and each slice is called a share. When you buy a share, you become a part owner of that company. It is like owning a small piece of something much larger, and that is a powerful feeling. If the company grows and does well, your share of that pie becomes more valuable. On the other hand, if the company faces challenges, the value of your share might decrease. Owning a share means you get to ride along with the company's journey, its ups and downs, successes and challenges. It is not just a financial investment. It is a way of being part of something bigger. Now, the place where this buying and selling happens is called an exchange. You might have heard of the New York Stock Exchange or NASDaq. These are just places where buyers and sellers meet to trade their shares. But there are also other types of exchanges where different kinds of financial products are traded. For example, there are options exchanges where people buy and sell options contracts. An option gives the holder the right to buy or sell a stock at a specific price before a certain date. It is a way to make money from changes in the stock price without actually owning the stock itself. Then there are futures exchanges where people trade contracts that agree to buy or sell something at a set price in the future. Futures are often used for commodities like oil or gold, but they are also used for stocks. Think of these different exchanges as different sections of the same big marketplace. Some people are trading shares of companies, others are dealing in options, and others are focusing on futures. All these exchanges together make the stock market a diverse and dynamic place. It is not just a marketplace for ownership in companies, but also a place for trading ideas, managing risk, and speculating on what might happen next in the economy. Each exchange has its own rules and types of products, and together they help make the financial world function smoothly. So, why do people invest in stocks? The main reason is to grow their money. If you buy a share of a company and the company does well, the value of your share increases. You might also get something called a dividend, which is like a small thank you payment for owning that share. It is pretty amazing to think you can make money while you sleep, right? This is why people want to invest in stocks. Before we dive into more details, let us get familiar with some key terms. These are going to pop up a lot, so it is helpful to understand them from the start. A stock represents ownership in a company, and a share is just one piece of that stock you can buy or sell. The price of a stock is simply how much it costs to buy one share. This price can change during the day based on how many people are buying or selling. Companies are listed with unique symbols called ticker symbols. Think of these like the company's nickname. For example, many large companies, like technology firms, have recognizable ticker symbols that make it easy for investors to quickly find them. These symbols help you identify the company you are interested in without any confusion. Different types of companies list on the stock market for different reasons. Some might be well-established manufacturers, while others could be exciting young technology firms looking to grow. Listing allows these companies to raise money by selling shares to the public, which they can use to expand their business, develop new products, or enter new markets. Another important term is volume. Volume tells us how many shares are being traded. If there is high volume, that means there is a lot of activity, and if the volume is low, fewer people are trading that stock. Volume can give us clues about how popular or interesting a stock is at the moment. Now, let us talk about reading a stock quote. A stock quote gives you a snapshot of the current price and some other key details. The current price is what people are paying for the stock right now. You will also see the day's range, which tells you the highest and lowest prices for the day. This shows you how much the stock has moved in a single day. You might also see something called the 52-week high and low. This tells you the highest and lowest prices the stock has been at over the past year. This helps us see how the stock is doing in the long term. There is another term called market cap, which is short for market capitalization. This tells us the total value of all the company's shares added together. Market cap is an important factor that helps us understand the size of a company and how it fits into the overall market. Companies are typically grouped into three main categories based on their market cap: large cap, mid cap, and small cap. Large cap companies are well established and tend to be more stable. They are often leaders in their industries and have a history of steady growth. Because of their stability, large cap companies are generally less risky, and their stocks are often seen as safe investments, especially during uncertain times. Mid-cap companies are those that are still growing, but are not as large as the big players. They have more room to expand compared to large cap companies, but they are also a bit riskier. Many investors like mid-caps because they offer a balance between growth potential and stability. Small-cap companies are usually newer or still developing, which means they have a lot of growth potential. However, with that potential comes higher risk. Small-cap stocks can go up or down quickly, which makes them exciting but also unpredictable. Investors who are willing to take on more risk often look to small-cap companies for the chance of higher returns. Understanding market cap helps you see where a company stands compared to others. It also gives you an idea of the level of risk you might be taking when investing. A balanced portfolio might include a mix of large cap, mid cap, and small cap companies to help manage risk while still offering the potential for growth. Next, let us learn about stock market charts. Charts are very helpful for understanding how a stock's price has changed over time. A basic line chart is the simplest way to look at this. It just connects the dots between the closing prices of the stock for each day. It is easy to read and gives you a good sense of whether the stock has been going up, down, or staying about the same. But if you want more detail, you can use a candlestick chart. Candlestick charts show the opening price, closing price, high price, and low price for a certain time period. They are called candlesticks because they look like candles. If the candle is green, that means the price went up that day. If it is red, the price went down. Candlestick charts help you see not just where the price ended, but how much it moved during the day. You can also look at different types of charts, each offering unique insights into a stock's performance. One of the simplest charts is the line chart, which connects the closing prices for each day, giving you an easy way to see the stock's trend over time. This type of chart is great for seeing the overall direction a stock is moving. Another common type is the bar chart. A bar chart shows the stock's opening price, closing price, as well as the highest and lowest prices for a given time period. Each bar gives you a snapshot of how the stock moved during that period, which helps you understand the level of volatility. Candlestick charts are another popular option and provide even more detail. Candlestick charts show the opening price, closing price, high and low for a specific time frame, like a day or an hour. The body of the candle represents the difference between the opening and closing prices, and if the candle is green, it means the price went up. If it is red, it means the price went down. This type of chart is especially useful if you want to see the daily sentiment and price movement. There are also charts that help show trends over different time frames, such as weekly or monthly charts. A longer time frame, like 1 year or even 5 years, gives you a big picture view of how the stock has performed over time. It helps you see if the stock is generally trending up or down. On the other hand, a shorter time frame, like 1 day or 1 week, lets you see what is happening right now and can be helpful if you are interested in short-term trading. Different charts can show you different aspects of a stock's story. Depending on whether you are looking for long-term investment opportunities or shorter-term trading chances, choosing the right chart is important. By understanding what each chart offers, you can make better decisions about when to buy or sell. Let us also talk about stock market indices. An index is a group of stocks that represent part of the market. The most famous ones are the S&P 500, the Dow Jones Industrial Average, and the nasdaq Composite. These indices give us a picture of how the overall market is doing. For example, the S&P 500 tracks the 500 biggest companies in the United States. If the S&P 500 is going up, it usually means the market is doing well. If it is going down, that might mean there are challenges in the economy. Investors use indices as a way to see if their stocks are doing better or worse than the overall market. Have you ever wondered what makes stock prices go up and down? The simple answer is supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell it than buy it, the price goes down. But there is more to it than just that. Company performance is a huge factor. When a company reports good news, like higher profits or a new successful product, the stock price can rise. If there is bad news, like missed earnings or trouble in the business, the price might fall. News plays a big role too. Things like changes in government policies, world events, or economic reports can affect the entire market. Good news makes investors feel positive, which can push prices up. Bad news can make people nervous, causing prices to drop. And let us not forget investor sentiment. Sometimes stock prices move just because of how people feel. If investors are excited and confident, they buy more and push prices higher. If they are worried or uncertain, they sell and prices drop. Let us talk about two different ways to invest. There is long-term investing, and there is short-term trading. Long-term investing means you buy stocks and keep them for a long time, sometimes for years. The idea is to let the company grow and for your shares to become more valuable over time. This is a great way to save for things like retirement, because you can let your money grow without worrying too much about daily changes in the stock market. On the other hand, short-term trading means buying and selling stocks quickly, sometimes in the same day. This is called day trading. It is riskier and can be stressful, but some people like the thrill of trying to make quick profits. Which one is right for you? If you are just starting out, long-term investing is often a safer way to begin. Once you learn more, you can decide if short-term trading is something you want to try. All right, now that we have covered the basics, here are some practical steps you can take to start reading the stock market. First, set up a watch list. A watch list is simply a list of stocks you are interested in. By tracking a few stocks, you will get used to how their prices move up and down. You will start to notice patterns and learn what affects their prices. A watch list can be valuable for many reasons. For someone just getting started, it helps you focus your attention. Instead of getting overwhelmed by the thousands of stocks available, you can zero in on a handful and really get to know them. This can make the stock market feel much more manageable. If you are a long-term investor, a watch list allows you to keep an eye on companies that you think have good long-term potential but might not be ready to buy just yet. You can track their performance and wait for the right time to invest. It is like having a short list of opportunities that you are preparing for when the time is right. For more active traders, a watch list is crucial for spotting opportunities quickly. If you are interested in short-term price movements, having a watch list helps you react faster when a stock's price hits a level that you have been waiting for. It is all about being prepared and knowing when to take action. Another perspective is that watch lists can help you learn more about different industries. You might want to add stocks from a few different sectors like technology, healthcare, and finance so you can see how they behave differently. This is a great way to broaden your understanding of the market as a whole. Overall, keeping a watch list helps you stay engaged with the market, track potential investments, and understand how different factors impact stock prices. It is a simple but powerful tool to help you build your knowledge and confidence in investing. Second, follow the news. Pay attention to financial news because it plays a huge role in the stock market. Company announcements like earnings reports can cause a stock to jump up or drop suddenly. When a company reports higher profits than expected, its stock price often goes up, and when it reports disappointing results, the price might fall. Economic data, like reports on employment numbers or interest rates, can also have a big impact. For example, if new data shows that the economy is growing faster than expected, investors may feel optimistic, and stock prices could rise. On the other hand, if there is negative news such as rising unemployment or inflation, investors might get nervous and sell off their stocks, causing prices to drop. Even global events can shake the market. Political changes, new government policies, or major international events can all influence investor behavior. News about technological breakthroughs or changes in industry trends can push entire sectors up or down. Keeping up with these types of news stories helps you understand why the market is moving in a certain direction and can give you insights on which stocks might be worth paying attention to. The news also impacts investor sentiment, which is basically how investors are feeling about the market. If the overall mood is positive, stock prices tend to go up because more people are buying. If the news is bad, investors might panic, leading to a drop in prices. By understanding how the news affects the market, you will be better prepared to react and make informed decisions. Third, try paper trading. Paper trading is when you pretend to buy and sell stocks without using real money. This way, you can get comfortable with how the market works without any risk. It is a great way to practice until you feel ready to invest real money. Now let us go over some common mistakes that beginners make. The first mistake is chasing hot stocks. Just because a stock is getting a lot of attention does not mean it is a good idea to buy it. Hot stocks can go up fast, but they can also drop just as quickly. It is important to do your research before buying any stock. Another mistake is overtrading. Overtrading happens when you buy and sell stocks too frequently. This can cost you a lot of money in transaction fees and taxes, which can really add up over time. Not only that, but constantly trading can also mean you miss out on the natural growth that comes from holding onto good investments for the long term. Remember, every time you trade, you are often paying a fee, and these fees can slowly eat away at your profits. Overtrading can also lead to making decisions based on emotions rather than logic. The stock market can be unpredictable in the short term, and reacting to every small movement can lead you to buy high and sell low, which is the opposite of what you want to do. When you trade too often, you are more likely to let fear or greed influence your actions, leading to poor investment choices. To avoid overtrading, it is helpful to have a clear plan or strategy. Decide ahead of time why you are buying a particular stock and how long you plan to hold it. Set goals for your investments and stick to them unless there is a strong reason to change. Another helpful approach is to practice patience. Sometimes the best thing to do is nothing at all, just let your investments grow over time. Focusing on long-term goals rather than short-term fluctuations can help you avoid the urge to overtrade and allow your investments to reach their full potential. Remember, investing is about making smart, informed decisions, not just quick ones. It is okay to wait and let your investments grow steadily over time, and this approach often leads to better results in the long run. And finally, do not ignore research. Research is one of the most crucial parts of investing because it gives you the information you need to make good decisions. Before buying a stock, take the time to learn about the company. What does the company do and how does it make money? Understanding this is important because you want to be confident that the company has a solid business model. Ask yourself whether the company is growing. Look at its financial statements to see if revenues and profits have been increasing over time. Growth is often a sign of a healthy company that might continue to perform well in the future. Another part of your research should be understanding the industry the company is in. Is this an industry that is expanding, or is it facing challenges? A company might be great, but if its industry is shrinking, that could affect its growth potential. It is also a good idea to look at the competition. How does the company compare to others in the same industry? Is it a leader, or is it struggling to keep up? You should also look into the management team. Strong leadership is key to a company's success. Do they have experience, and have they been able to steer the company through tough times? Management's vision and ability to execute their strategy can make a big difference in how well a company does. Research also involves understanding the risks. Every company has risks, whether they are related to the economy, competition, or specific challenges the company is facing. Knowing these risks helps you decide if the potential rewards are worth it. By doing thorough research, you can make informed decisions and feel confident about your investments. It also helps you avoid buying into hype or making decisions based on emotions. Remember, investing is about making smart choices, and the more you know, the better those choices will be. You want to make sure you are buying stocks in companies that you understand, believe in, and see a future with. To recap what we have learned, understanding the stock market means knowing the key terms, learning how to read stock quotes and charts, and staying informed about what moves stock prices. Take your time and do not rush. The more you learn, the better you will get at making good investment decisions. Keep asking questions and stay curious. With each step, you are building your knowledge. You have already made a great start, so keep it up. Remember, everyone starts as a beginner, and learning is the most important part of the journey. Thanks for joining me today, and good luck on your investing adventure.